Hi again, once again, welcome. So in this final piece of the for the first session, okay, I'm going to introduce you to the concept of consolidation. Now, it's very important we try to keep this. Don't forget it. I'm sure you were introduced briefly to it or sometime in financial accounting practice. But if you don't even know anything about consolidation, don't worry. Okay, don't worry. It's quite easy, straightforward. Like I said, you love it, you understand it. You again meet the concept of consolidation, control in business taxation. I remember I taught business taxation last year, and it comes up again in terms of taxation. So you meet it. Okay, so once you've taken upon yourself this discipline of accounting practice, okay, you see it. Okay, so I'm going to share my screen on this last bit for the first session, after which we'll wrap it up, okay, and try to solve some more questions along the line. Okay, so in the consolidation process, one key item comes up, and that is goodwill. But I've intentionally reserved goodwill for next week so that you don't get so much information, you don't get overburdened with all of these intangibles and recognition criteria and so on and so forth, and getting into these, okay? Just one step at a time. All right. So we know the schedule for this week or for this session. So we've looked at introduction to IFRS. We've looked at intangible assets and introduction to group accounts. That's what we're doing now. Just say, you know what fair value is? Like we just mentioned, fair value, looking at comparing it to the market. What is prevailing at an arm's length transaction on the market, on the open market? Okay. So we're looking at fair value. All right. Then goodwill, we know what it is. What about associates? Okay. So we're going to look at this. And then we delve that. So like you saw, like you can see the week commencing 24th January, we'll be looking at goodwill, fair value adjustments in detail. Or the second week, I don't want to put the dates there because possibly the dates could change. So in the second week, we look at goodwill, fair value adjustments, and reserves and non-controlling interest. So on. Okay, let's move on. So in terms of group account, the basic idea is all about control. Okay, can we control? Do we control? What does it mean to control? Okay, so company P, parent, and company X, the subsidiary. Okay, so we're looking at recording an acquisition in the parents' books. Okay, and then consolidating all of the financials of the subsidiary into that of the parents. Okay, so that's what we're looking at principally. Take an example here: the P group of companies. Okay, now you realize that P. Let me just connect this in a second so that I can annotate on the screen. So look at P. Okay, look at P clearly. You realize that P stands here as the mother company, the parent company. And we have been told that it has some subsidiaries. So subsidiary 1 is Q, subsidiary 2 is the R, and the third one is S. Controls these guys. Okay, that's it. So it controls all these subsidiaries. But the element of control comes into place when the investor wills a certain percentage in terms of share equity. That's normally how we measure it. But before we move into that, we always want to see the element of control theoretically. What does it mean? Okay, so it means all of the following. One, when you have power over the subsidiary, power in terms of decision making, in terms of representation on the board, in terms of okay, any structural changes, any significant changes, or you have power to let go or to let it stand. Okay, anyone. Again, it also includes exposure to having the right to variable returns from its involvement with the investee. So any variable, you have the right to any variable returns that accrues from the subsidiary. Now you also have the ability to use your power to affect the amount of investor returns. Okay, so that's theoretically what it means. Again, I'll entreat you to look more into the financial in the books, okay, where you get to understand these concepts in depth. ACCA provides a more expanded definition on that. Okay, but I'll leave it this way. So look at it: power over the subsidiary, and also the right to use this power to to affect or to influence the returns that the subsidiary acquires, and exposure to or rise to variable returns from the subsidiary. Now, like I said, in terms of measurement, in terms of quantification, okay, we normally will assume that control takes place when you have more than 50% of the voting shares, of the ordinary shares, of the equity shareholding. Okay, so if I own 50% plus, more than 50, so I get 51% of voting shares, I'm considered someone who wields control over that subsidiary. Okay, now if you have less than 50%, you could also wield some control. Okay, it's quite interesting to know. Sometimes you could have less than 50 and still have control. In that case, control exists when you have power over one half of the voting rights by virtue of agreement with the other shareholders. So I hold less than 50%, but the other shareholders gives me that technical advantage to be able to have more than 50%, more than one half of the voting rights. They give me that, they confer upon me that privilege. Okay. Again, when I have the power to govern financial and operational policies under statute or agreement, so the statute, agreement, the regulations, the legal regime within that has been established gives me that right to be able to govern the financial and operational policies of the company. Again, if I own less than 50% of the equity, the voting rights, the voting shares, but I have the power to appoint or remove directors or key staff from the organization, it gives me control. Okay? It gives me control. But in reality, when we are working, we'll be dealing with the numbers, the percentage holdings. Okay? But this also stands at the edge. Take note of it. In case it comes in your theoretical or your narrative questions, your assessments, you could always write on that. Take an example. Direct control. So we'll be dealing with the 50% plus. Okay? The 50%. We'll be dealing with the 50% plus. All right. Anything starting from 51%, we then would say control. We will the control. Parent P. Can you imagine its shareholdings in S1, S2, S3, S4, S5? All of them. This is the list. This is the list. But it is even 51%. So we can say that from S1 to S5 are all subsidiaries which are controlled by P, parent P. Okay? Easy. All right. Look at this again. You realize that P controls 51 of S, but then S1 controls 75% of S2, and S2 controls 60% of S3. Which one is a subsidiary of parent P? Okay, I need to get a calculator so that I will do the calculation effectively. When you see situations like this, it's easy to identify the first line. Okay, so realize that P controls or owns 51% of S1. So control is there, right? But between this and this, to get the effective control for P, okay, effective rate of control of P, it will simply be the 51%, this one, against this, times 75%. What do we get? Okay, so the 51% times 0 times the 75% will give us 38%. Okay, it gives us 38.25%. Take note of this. If you want to know the effective control rate for P over S3, it will be the same. Okay, so P to S3 will be what? 51% times 75% times 60%. Sorry, my lines are rewriting. Okay, so again, that's 51% times 75% times 60%. Okay, and that one gives us 22. 0.95%. This is a clear-cut situation of associate. So it is only this guy who will be a subsidiary, but these two, S2 and S3, are not subsidiaries of P. Instead, they are associates because their percentage holding is 38.25 and 22.795 respectively. But, you realize that S1 holds what? 75% of S2. Therefore, S2 is a subsidiary of S1. Okay, S2 is a subsidiary of S1. Similarly, S2 holds what? 60% of S3. So S3 is a subsidiary of S2. Why? Because the percentage holdings here are what? More than 50% in each case. Okay, they are more than 50% in each case. So this is a subsidiary of this guy. This is a subsidiary of this guy. This is a subsidiary of the P. But these S2 and S3 are not subsidiaries. Okay, they will only receive dividends. So whenever there's a dividend declared, you realize that P will receive 38.25% dividends of S2. Whenever dividends are declared, P will get 22.95% of S3's dividends. That's it. It makes S2 an associate and S3 an associate. So these are all associates of P, not subsidiaries of P. All right. Good. Take note of the computation. All right. So the first thing, the impact of control will give us the right to consolidate, to add all the assets of the parent and the subsidiary, the liabilities, the income, the expenditure. Okay. And this all must be represented in the books of the parent. Okay. Remember, the parent is taking over the subsidiary, so you consolidate all into one single entity. So you get the P group of companies. All right. Now, in terms of control, remember in the first situation, if P owns, let's say, 60% of S, it means it's not owning all the 100%. So who owns the remaining 40%? It may not be one person. It may be a number of other shareholders who are owning the 40%. So this 40% shareholding is what we call the non-controlling interest. In the past, we used to call it the minority interest, but it has metamorphosed into non-controlling interest. So that's what we mean by non-controlling interest. So we include all the subsidiaries, its assets and liabilities into that of the group account, regardless of the fact that 40% is owned by the non-controlling interest. We'll represent the non-controlling interest actually in the books of the parents. Okay. So ownership of the shares by the non-controlling interest is reflected separately, like I said, and it will be shown on the face of the statement of financial position. We'll look at non-controlling interest later in the next session, where we look at the computation step by step. All right. Take a simple example here. Company P, okay, and Company S. These are the financial statements, just a simple balance sheet, okay? So we got a property, the inventory, the cash, and then equity and liabilities fairly represented, okay, as of January 2018, okay? Now we are told that P acquires 100%, so there's no minority interest. There's no non-controlling interest. Sorry, I used the word minority interest. There's no NCI. Okay, so it owns 100% of the shares. And we are being told that it acquired it for 1.3 million. It paid 1.3 million to acquire everything, to acquire all the identifiable net assets. All right. Question is, show how P will record this investment. P, how will the company P record this investment? In reality, you realize that once you have doled out cash, you've given cash and bank, you credit your cash and bank. Is that not it? But the 1.3 we paid, ordinarily, You will say it is an investment we have made as a company in S. So investments, you debit it. Investment in S. Okay, simply. We'll write this in the journal entries. Is that not it? Very easy, right? Now, in terms of consolidation, you realize that our cash had reduced by 1.3 million, but we have a new item, investment in S, 1.3 million. Everything here remains the same. Everything here remains the same. This is a new item which has been introduced. Okay, and our cash had reduced from 1800 to 500. Okay, so these are the new things which have popped up. But again, when we add up, everything balances, right? Nothing affects the equities and liabilities for now. For now. Okay, so now let's move on and see what will happen. What will happen? Okay, so this will remain unchanged from year to year, but what will happen? Okay, in reality, when we consolidate, what do we do? IFRS 10 requires that when a parent has a controlling interest, it needs to produce a consolidated set of financial statements. The aim is that we want to record the substance of the relationship than the form, substance over form. So don't just leave the subsidiary to report. They can do it independently for their management. But at the end of the day, the IFRS requires us to consolidate it, bring them together as a group. Okay. So this additional set of books that we prepare together, one consolidated book is what we call a consolidated financial statement. That's what we're doing now. Okay. Here, what do? We try to present everything as one. The income statement, the statement of financial position. We want everything to appear as one single. In fact, consolidation does not just affect the statement of financial position. Usually we are tested on the financial position, but it affects the income statement, the expense line, the income. We consolidate that one. Okay. Even the cash flow statement is consolidated. So but for now, we're not going to consolidated cash flow statement. We look at the income statement. We look at the statement of financial position. That's a balance sheet, but we're not going to consolidated cash flow. That is more of the strategic business reporting. So like I said, the aim is to bring all into one single entity under the control of the parent. So we issue these to the shareholders of the parent company for them to know that, okay, this is where our investment went to and this is what the performance is like. Transparency. Remember when we look at introduction to one of the objectives of IFRS to promote transparency, stewardship, accountability to the owners. Okay. So that is it. So we normally issue these consolidated accounts in addition to the parents' own financial statements. Okay. All right. So the P group, remember we said we acquired a company on 1st January. We'll come to goodwill later. Just take it one step at a time. It acquired a company. Okay. We look at the position for P and S. Okay. Now, this is what we found. This is the investment we made, right? And our cash had reduced. S did not really have any investment yet. That's why you have a nil there. But this is financial statement stands as it is. But what do we do? Interestingly, remember, we paid 1.3 million to cover the fair value of its net, or the fair value of the identifiable net assets. Normally, we will equate the identifiable net assets to the share capital and the reserves. We assume that all the 1.3 million we paid covers everything of the share capital and the reserves. It is quite easy here because we are acquiring 100%. Okay, so I know you say, well, this makes life easy. It makes life easy because it's coincidental. If you add these two, you get 1.3 and this is 1.3. So it makes life easy. Okay, easy for consolidation. But there can be some technicalities along the line. Don't worry, we'll get there. Okay, so first we cancel the investment in the P, the 1.3, with the shares and reserves. The shares, how much is the shares? 100. Okay, and the reserves 1 to 100. Normally the reserves will be equated to the retained earnings. Okay, the retained earnings and that we have in the books. Okay, so we'll look at this. At the end of the day, we then aggregate the two financial statements and it should jive. Okay, it should jive. What we'll be doing is that we'll add all the assets, we add all the liabilities, but we don't add the equities. Okay, we don't add the equities. We don't add the reserves. No, we have to just massage them by equating it to the amount we paid to be sure whether we made some goodwill or we made a bargain purchase. All right. Otherwise, if you try to add a share capital, the reserves, you'll be double counting because you would have already counted it in goodwill. It depends. It tells you because the 1,300 against the identified fair value of the identifiable net assets will give you what is called a goodwill. So if you try that one again, you'll be doing double counting. Okay. So you realize that the 1,300 cancels out everything here. Simple as that. If this guy had some liabilities here, we would have added it to this, but it is 0. But then the next thing is we add these assets. Okay. The inventory, we add them. And of course, you are inheriting both the rewards and the risk, the cash. You add them. Okay. So at the end of the day, this is what you get. Add the two properties, you get this, inventories, and then the cash. All right. For share capital, like I said, you only pick that of the parent. The parent. Okay. And then you end up with the liabilities. You add it, you get this. Okay. We didn't get any goodwill here. Why? Because the amount we paid was exactly the same as the goodwill. Is the same as the equity and then the reserves. It is rare for us to be able to pay exactly as the fair value of the identifiable net assets. That's why we're not making any goodwill. Here we are saying we broke even. Okay, we broke even. But that's not the case. We can get more complicated ones. So we want to just use this as a teaser to tease you out, a refresher for you to know that there's nothing difficult. Okay, so features of a consolidated financial statement: there's no investment in subsidiary. This is totally out. Okay, instead we look at the assets and liabilities, we consolidate them, we add them. The share capital is only for that of the parent. The reserves is only for that of the parent. Okay, because these are prepared for the shareholders of the parent. Okay, we are not interested in the other guy's share capital. Shareholders want that of parents. Okay, the assets and liabilities will also show that liabilities will be controlled by the parent, the resources available to the company, and the debts, the debt components that the company holds. Okay, all right. So this is a quick introduction to it. Okay, it's a quick introduction to the whole concept of consolidation. 22 slides, we finished in 23 minutes, which is good, right? Which is good. So I think we'll end it here. I will not take much of your time, and then hopefully we can pick up the study when we start with calculation of the goodwill and the reserves, how to adjust the reserves, the non-controlling interest, and fair value adjustment. All right. Thank you so much for your time, and I'll see you in the next session. Bye-bye for now.